clicked this because you want to learn how to day trade. This video, I'm going to explain what you should do to prepare yourself, explain the relevant tools and indicators and how to use them, and how you can create your own high probability trading plan. Alright, so I'm just going to assume you know what day trading actually is. So in order to prepare for a successful trading career, you're going to need to develop 3 key necessities. Number 1 is a series of logical trading techniques. Number 2 is the trader's mindset. And 3 is a proper risk management strategy. Now, you don't want to skimp out on any of them. Beginners will often only focus on number 1 and get discouraged by the markets by either lack of self-discipline, impulsive decision-making, and overall sloppy risk management, not because of a lack of technical knowledge. You're going to hear this all the time, but the main thing you don't want to do is let your emotions dictate your decision-making. Now, that doesn't mean you're a robot, as we're all prone to feeling emotion, but discipline comes from not acting on those emotions. This is why it is essential to develop a trading plan before entering a position. So when a trade eventually goes against you and you feel like panicking, you just stick to your plan and move on to the next one. It's hard enough already to know what the markets are going to do, but if you don't know what you're going to do,
gonna have a bad time.
Okay, so before I actually get into how to develop a trading plan, you're going to need to know how to use these tools and indicators. So you obviously need a broker to actually be able to buy and sell shares, and there's plenty of options depending on where you live. All right, so the most important piece of information on your chart for determining whether bulls or bears are leading the charge is going to be the price action. And this is going to be found on your chart in the form of candlesticks. If you haven't already, you're going to want to change your line style over from line to candle on whatever platform you're using. So the reason you're going to want to use candlesticks as opposed to a line chart is because it's just going to give you a more detailed picture as to what is actually happening. A candlestick represents a period of time, and that depends on the time frame you're looking at. The range in between the open and close is known as the body, and the highs and lows outside this range are known as the wicks. Because we're looking at the 5-minute chart, each one of these candles represents 5 minutes. The second thing you're going to monitor is the stock's volume, and that's typically going to be found as a default down here, but if it's not for whatever reason, you can add it as a subchart within your indicator section. You're looking for unusually high volume, and you can narrow down candidates by comparing the stock's daily volume versus the average daily volume over the past 3 months. Unusually high volume is going to be different depending on the certain ticker that is being considered. So let's just take Tesla, for example, with an average daily volume of 27 million and compare that with Houston American with an average daily volume of 8 million. If Houston American were to receive the same amount of volume as Tesla, which in this case they both received just over 19 million, Houston would have experienced what is known as a fundamental catalyst. So unusually high volume is going to be a leading indicator to let you know of a potential fundamental catalyst, and the price action is going to let you know whether it's good or bad. Why not just read the news? If you're not aware, the majority of the stock market's volume can be attributed to algorithmic trading, or computers just blasting trades off back and forth all day. The algorithms are going to know what's good way before anyone is able to take that information and publish it into an article. Now, how can we determine how big a move we can expect? Once you've identified a stock with unusually high volume, you're going to want to take that volume, and not the average volume, but the current daily volume, and compare that with the stock's free float. This is the number of shares that are available to be traded, and not to be confused with the shares outstanding, as that figure includes insiders, institutions, and shares under various lockups. So basically shares that have to go through some sort of process before they can be sold and not freely unloaded onto the market, and not something we have to concern ourselves with as a day trader. Okay, let's look at Tesla again with a free float of 843.5 million. Let's just say Elon sends out some crazy tweet and volume comes in at 200 million. We've seen multiple times Tesla run 20 to 30% in a single day, but we've never seen volume go past 300 million, or in other words, significantly exceed the free float. This would also explain why we've never seen Tesla run 200 to 300% in a single day. When we make the same comparison to Houston with a free float of 9 million, you can see that when volume doubled the free float, we got a really large run in a very short period of time. It's basic supply and demand. If there's a significant amount more buyers than there are shares available to be traded, shares are going to move very rapidly while simultaneously driving up the price. Keep in mind though, the lower the float does not mean the higher the reward. Sometimes moves are going to be too violent and get halted along the way. As a beginner, you're just going to want to stay away from those until you have your strategy dialed in. So price action and volume are going to be your leading indicators. I'm going to now talk about some lagging indicators that are going to help you further narrow down your stock selection. One that I and and many traders like to use is the Relative Strength Index, or the RSI, which measures the scale of price changes from recent highs and lows of a particular stock on a scale of 0 to 100. So a stock with an RSI of 70 or above would be considered overbought, and an RSI of 30 or below would be considered oversold. As a trader, we would ideally be looking to exploit a pattern of repeatedly going from oversold to overbought and back again. You can complement the RSI with the Moving Average Convergence Divergence, or the MACD, which shows similar overbought and oversold conditions as the RSI. What we're looking for in particular is a crossover of the MACD line over the signal line, known as a golden cross, which can be an indication that there might be a reversal in the current trend. These indicators are easy to understand, but definitely hard to master. I can't go into enough detail on this guide alone, as they can all be their own individual videos, which I will be releasing, so make sure to subscribe for that. Now, how do we take what we just covered and determine entry and exit points? You're going to need a moving average to determine exact locations. There are two main options for using a moving average: the simple moving average and the exponential moving average. For day trading, I like to use the exponential moving average because it puts a greater weight on more recent data points. So when you select your moving average, you're going to want one short-term and one long-term moving average. I like to use the 13 EMA and the 100 EMA. For simplicity's sake, I'm also going to throw the volume weighted average price in here, which is also a moving average. However, it's based off of volume instead of price action. As we can see here with MDVL, there was unusually high volume earlier in the day. We got a golden cross towards the end as it was coming out of oversold territory, and it closed above the moving average. As the trend continues, the stock might experience what are known as pullbacks towards the moving average. As long as the stock's price is maintained at this level, the moving average acts as support, as in the area where buyers are looking to enter positions and support the current trend. If a stock's price is trending below the moving average will act as resistance, as in the area where sellers are looking to unload shares and can potentially reject price action from moving even higher. A breakout occurs when buyers overpower sellers at a resistance level, and with other contributing factors can be confirmation of an uptrend. When this happens, the old resistance level will become the new support level. Now, the key word I was using to describe moving averages in relation to support and resistance is that it acts like it.
And scene.
So once a stock is trending above the moving averages, where is resistance? The VWAP acts as a harder support and resistance level than the EMAs, but to get a better idea of where buyers and sellers are likely targeting, you're going to need to look at previous price action. Pre-market highs and lows, you're definitely going to want to monitor to see how the intraday price action reacts at these levels. If a stock is carrying along and the rug suddenly gets pulled, what happened? Did everyone get tired of making money? Kenny up to his old tricks? Although rug pulls do happen in what appears to be a random manner on the stock market, you can often find the areas where these events are likely to occur by zooming out and looking on the daily. Drawing support and resistance lines takes a bit of practice, but is fairly easy once you have an idea of what you're looking for. The more tops or bottoms that you're able to connect in the current channel is the higher the likelihood it will continue to maintain that role. Now, these aren't exact price points, as you'll often hear them referred to as areas or levels, so you might actually find it easier to use a rectangle as opposed to a distinct line. Okay, so here's a quick summary of everything that we've covered so far. Most of it and what you'll be using as a day trader is considered technical analysis, which is trying to predict trends and patterns based off of chart setups. On the other hand, fundamental analysis consists of anything to do with the intrinsic value of the company. All right, so what is a trade plan and why do we need one? Well, it's the same reason your teacher asked you to show your work in middle school. It was so they could see how our dumb asses came up with the wild answers that we did. And that's why you need one too, so you can review your trades. Even if it's a bad plan, it's better than having no plan at all. This way, you can find out what's working for you and make the necessary tweaks to really start dialing in your strategy. An absolute basic plan must answer 4 things: your entry, your exit, your stop loss, and the reason why you entered the trade. All right, so this is what a trade plan might look like in action. Let's just say Frontline came across your scanner in the morning. The first thing I immediately do is pull up the daily chart and look at previous price action. So I can see that there's an area of support right about here and an area of resistance right about here. So when I come back to the 5-minute chart, I can see that unusual volume pushed price action above support with a golden cross on the MACD. So my entry would be confirmation of the 13 13 EMA, and let's just say I get filled at $9.20, my stop loss would be at $9, which would mean that it broke back down below support for a trailing stop loss of the 100 EMA, and my profit target would be resistance at $9.80. The reason why I entered the trade is because of unusual volume, plus a golden cross on the MACD and confirmation of the moving average. When determining your price target and stop loss, you must account for the 2-for-1 rule, which means that for every dollar that you're risking, you're potentially making $2. That doesn't mean though if you're only trading with $1,000, you must be making $2,000 on every trade. But if your stop loss is 20 cents below your entry, your price target must be at least 40 cents above. As we can see with this trade, I'm actually potentially making 60 cents a share versus a risk of 20 if the trade went against me. This ensures that you're a profitable trader even if you only have a 50% success rate, and you don't want to risk more than 2% of your account on a single trade so that it's not such a burden to make back any losses. You can certainly add to your trade plan by answering what you would do if certain conditions are met. Let's look at the same trade. Let's just say the stock price broke above resistance and confirmed it as the new support. Instead of taking all my profits at once, I could take half at my profit target, move my stop loss to just above, and continue riding the moving average until validation. That ensures that no matter what happens, I walk away from the trade with profit. And don't be afraid to move your stop loss up as price action continues moving along. The last thing you want to do is turn a winning trade into a losing trade. Okay, so you might be a little bit concerned about how you're going to find your strategy, but you don't need to create your own unique approach. There are already plenty of high probability strategies that have been established and used for decades by professional traders. I'll explain in detail some of the most popular and how you can refine them to suit your trading style in this video right here.
Okay, you see what he did? He French fried when he should have pizzaed. You French fried when you pizza, you're gonna have a bad time.